Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. In this members update video, we're going to look at how the $40,000 SALT cap contained in the One Big Beautiful Bill Act really works. So starting right here in this part of the chart under the standard deduction scenarios. If you are a single filer for 2025, your standard deduction is $15,000. And if you happen to be 65 years or older, you will get another $2,000 on top of that for a grand total of $17,000. If your filing status is married filing joint, your standard deduction for 2025 is $30,000. And in this case, there will be an extra $1,600 bump per person for each individual 65 years or older. So for example, if both spouses are over 65, then your standard deduction will be $30 plus another $1,600 plus another $1,600 for a grand total of $33,200. Also note there is a possible additional $1,000 for single filers and $2,000 for married filing joint as an increase to the standard deduction for 2025. In other words, retroactive for 2025 as soon as the One Big Beautiful Bill Act passes. So just picture another $1,000 layered on right here and another $2,000 layered on right here should these provisions become the law. Alright, now here is where it gets interesting. Let's go to the itemized deduction scenarios. So right here in this column, let's assume that for 2025, these are your actual expenses that are potentially eligible to be deducted as itemized deductions. Number one would be mortgage interest. Let's just say you have $12,000. The second major category is charitable contributions. Let's assume for this example you have $10,000 in 2025. And then the third major category is going to be your state and local taxes. This is the item where the limitation is increasing from $10,000 up to $40,000 under the One Big Beautiful Bill Act. But for this example, let's assume that the actual state and local taxes that you incurred for 2025 was $17,000. So to sum those up, your actual expenses are $12,000 plus $10,000 plus another $17,000 for a grand total of $39,000. So that is your actual expenses incurred. Now, under the current law, pre-OBA, I'm going to refer to the One Big Beautiful Bill Act as OBA for the remainder of this video just for simplicity. So pre-OBA, in other words, the current law in 2025 before OBA gets signed into law, the state and local taxes are limited to a deduction of $10,000. So even though you actually incurred $17,000 of expense out of pocket, your deduction would only be limited to $10,000. So right here we have a $7,000 limitation in this example. You actually incurred 17, but you were limited to only 10. So pre-OBA, under the current law that is in place, this total itemized amount would only be $32,000. If you were in this situation right here, married filing joint, both spouses are age 65 or older, your standard deduction of $33,200 would be more than the amount allowed over here pre-OBA. So in this situation, you would not end up itemizing. These deductions would not do anything for you from a tax perspective, and you would just take the standard deduction of $33,200. Now, of course, if both spouses were not age 65 or older and your standard deduction was $30,000 right here, then you would end up itemizing right here at $32,000 since this one is larger. However, under OBA, this limitation right here of $10,000 is scheduled to be adjusted up to a limit of $40,000. Now, that doesn't mean you just get to deduct $40,000. You only get to deduct up to the amount you actually incurred, limited to $40,000 maximum. But in this situation right here, OBA would allow this full deduction of $17,000. So back to the couple who is married filing joint, both spouses age 65 or older with a standard deduction of $33,200 right here. Post OBA, assuming that these provisions get signed into law, if this was your situation, you would no longer be limited to this $32,000. You would actually be able to itemize up to the tune of $39,000 in this example. Note that over here, even if the additional $2,000 married filing joint standard deduction increase gets passed, in the example we're talking about, that would bump this up to $35,200. Itemizing over here at $39,000 would still be more beneficial, and so you would still get the advantage of the increased limit to state and local tax deduction, which again is scheduled to now be a $40,000 limit. Now, what if you are a single filer over here? Well, in that case, the comparison that you're going to do is exactly the same, except the standard deduction threshold is lower. So if you were a single filer over the age of 65 and your standard deduction was $17,000, if this was your itemized deduction situation over here, you would be itemizing both pre-OBA and post-OBA. This change in the law that allows more state and local taxes to be deducted is probably going to be less impactful on single filers and more impactful on those married filing joint. And the reason is because single filers under the current law, pre-OBA, are more likely to itemize anyway. The reason being that if you're single or if you're married, you may still live in the same size house with the same size mortgage payment. You may still have the same amount of state and local taxes incurred. You may still be giving a similar amount to charity. So many times the amount that people have available to potentially itemize deductions is a similar amount, even if they're single versus married filing joint, whereas the standard deduction threshold that you have to exceed in order to itemize in the first place is significantly lower for a single filer, making the likelihood much greater that they will itemize anyway. Now, real quick before going over here to this OBA scenario, what about medical expenses? I thought you get to itemize those as well. Well, the answer to that is yes, you potentially can itemize unreimbursed medical expenses. However, that's a very high threshold to meet. Your unreimbursed medical expenses have to be greater than 7.5% of your AGI in the first place before they are even considered as a potential itemized deduction. And for most people, getting medical expenses out of pocket unreimbursed in excess of 7.5% of your AGI is relatively uncommon. So generally, you're not going to see any medical expense deduction unless you have incurred a significant amount of medical expenses in the year. In most cases, the three major categories of itemized deductions are going to be state and local taxes, charitable contributions, and mortgage interest. Now, going over here to this OBA scenario, there is an additional potential $4,000 to $6,000, what I'm going to call a senior bump, that could potentially become the law. I believe the provision is $4,000 under the House version and $6,000 under the current Senate version of the Act. This item is an additional standard deduction for seniors that apparently will still be available even if you are itemizing. However, note that this additional senior bump or increase in the standard deduction is subject to income range phase outs. In other words, if your income goes too high relative to the thresholds that will be laid out in the new law, then this will phase out ultimately down to zero. However, continuing with the previous example, let's say that you are not phased out based on income. Well, then the combination of both the increased threshold to allow the deductibility of state and local taxes, plus the potential senior bump right here, could get the married filing joint couple that we have been discussing in this example all the way up here to potentially $43,000 to $45,000 of deduction, as opposed to right over here the $33,200, or potentially it would be $35,200 if this $2,000 additional bump just for the married filing joint filing status in general gets passed into law. But still, even $35,200 is a significantly lower amount, about $10,000 lower than this potential $45,000 over here. So to summarize, if you are in a situation where you have significant state and local taxes and the previous limitation of $10,000 was causing you not to be able to itemize in previous years, it is certainly possible that you will be able to itemize now under OBA. And if you are an individual in that situation and you are a senior that is not phased out of this additional standard deduction right here, you have the potential for deductions that are probably significantly larger over the next 4 years than they have been since about 2017, when the original Tax Cuts and Jobs Act was put into law, which is what created this $10,000 limitation in the first place. As I just mentioned, note that this senior bump right here is only available between 2025 and 2028 under the proposals in OBA. So it's a 4-year provision that you may be eligible for. And if you are a member of the Personal Tax Planning Template Program and you're considering doing Roth IRA conversions over the next 4 years anyway, this senior bump right here is potentially a free Roth IRA conversion, so to speak. In essence, it could allow you to convert another $4,000 to $6,000 per year over the next 4 years. And while you would still be in the same tax position as far as the amount of tax owed pre and post OBA, you would be getting an additional $4,000 to $6,000 Roth conversion done every year for 4 years. The same concept can also be considered related to this state and local tax deduction. If you were right here over the last few years and you were limited to $10,000 when really you had, let's say, $17,000 available, that extra $7,000 that you now will be able to deduct under OBA can also be considered a free Roth IRA conversion if you're doing Roth conversions anyway. So in this example right here, $7,000 plus another $6,000 if the Senate version of the bill gets passed into law, that's $13,000 additional deduction annually. Note also that this provision, this increase up to the $40,000, is also limited to this time period. The cap will revert back to $10,000 under the current proposal after 2028. So if you're considering doing Roth conversions or you haven't even thought about it yet, now would be an amazing time to see if you would be a good candidate. Because, for example, like right here, this is an additional $7,000 of deduction plus another $6,000 if the Senate version gets passed. That's $13,000 of extra deduction that you could use to offset Roth IRA conversion in each year for the next 4 years. If you are new to my channel and don't know much about Roth IRA conversions and the amount of tax, tens of thousands of dollars that you could save for yourself and your family over the course of your life by considering this tax planning strategy, make sure to check out my popular 2025 Roth IRA conversion and estimated tax planning videos. Some of the most popular ones right now: how to actually calculate a Roth IRA conversion, how to deal with RMDs in the context of doing Roth IRA conversions, IRMA considerations in the context of doing Roth IRA conversions, and of course a complete 2025 updated example of how to calculate your estimated taxes under the safe harbor. You can find links to all of the videos above in the description below this video, or just search on YouTube for Number Crunch Nerds Roth IRA Conversions. That's going to be it for today's members update. Thanks everybody for watching, and I'll see you next time.